Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at USA Rare Earth.
If you find our talks useful, please consider subscribe, like, and comment underneath. So today we are looking at this financial paradox that honestly makes absolutely no sense on paper.
Yeah, it really doesn't.
Right. Because if you're listening to this and you're, scanning the market for value, what do you usually do when you see a company with barely $1 million in revenue and like an $80 million net loss?
You run. You don't walk, you just run in the opposite direction.
Exactly, you run. But looking at the numbers and the filings for USA Rare Earth, there is this massive catch. This same company that lost $80.03 million last year is currently sitting on a staggering $1.75 billion mountain of cash.
Right, and that disconnect, between that blood red income statement and their basically bulletproof balance sheet, that is the entire key to this analysis.
It's completely wild.
It is. Because if you evaluate them like a traditional software startup or, a legacy retailer, the numbers look terrifying. But what we are really decoding today is this massive structural transition.
Right.
USA Rare Earth is evolving from a speculative mining developer into something completely different. They're becoming the West's only fully integrated mine-to-magnet rare earth supply chain.
So they're basically maneuvering to own the entire processing ecosystem, entirely outside of Asian influence.
Exactly. And that's why you have to dig right into that balance sheet first. Before we even glance at the stock price or the technical charts, we really need to understand why burning millions of dollars is actually the core of the bullish thesis here.
Yeah, let's look at those numbers because they're intense. If you look at their fiscal year 2025, revenue was a negligible $1.64 million.
Basically nothing.
Right, nothing. That tiny blip came purely from some small-scale third-party processing fees through a subsidiary they own called Less Common Metals. Meanwhile, their operating loss hit $59.5 million.
Which is a heavy burn rate.
Huge. I mean, they burned $37.36 million on capital expenditures in the fourth quarter alone. On top of that, you have $18.5 million in what the filings call SG&A, which, essentially just means overhead.
Yeah, selling, general, and administrative expenses.
Right, paying the management, the architects, the lawyers, all of that.
And that kind of cash burn would normally be a massive red flag. I mean, usually you'd be terrified.
Right, but I like to think of it like watching a crew build a massive cross-country toll road. Right now, they are heavily burning through cash just to blast through mountains, clear the land, lay the asphalt,
That's a great way to put it.
Yeah, because if you try to judge their business model based on toll collections today, you're missing the point entirely because the road isn't finished yet. The losses are quite literally just the cost of building the rails before the trains arrive.
Absolutely. And in the mining and heavy processing industry, that period is defined by a concept known as the Valley of Death.
The Valley of Death sounds intense.
Oh, it is brutal. It's this multi-year period between proving you have valuable rocks in the ground and actually generating cash flow from a finished manufactured product.
And I'm guessing a lot of companies don't make it out.
Most don't. The reason most Western rare earth competitors die in that valley is that the capital expenditures required to build processing plants are just astronomically high. Private financing usually dries up way before they finish.
But USA Rare Earth didn't dry up.
No, they effectively filled in the valley. I mean, they went from having $16.76 million in cash at the end of 2024 to $1.75 billion by the end of 2025.
Okay, let me stop you there, because going from $16 million to nearly $2 billion in cash overnight completely changes the gravity of a company. How did they pull that off without generating any real revenue?
Through a completely unprecedented capital stack, the transformation was driven by a massive $1.5 billion PIPE financing deal that closed in January 2026.
Right, and for listeners unfamiliar with the term, a PIPE stands for Private Investment in Public Equity.
Exactly. It essentially means large institutional investors, like the true heavyweights, agreed to buy a massive block of shares directly from the company to inject an absolute flood of cash.
So big money institutions basically bankrolled the rest of the toll road construction.
Precisely. And the capital injection didn't even stop there. They also have a pending $1.3 billion senior secured loan from the Department of Commerce.
Wow, so the government is stepping in too.
Yeah, and what you need to understand about that loan is the structure. It comes with a 15-year term and heavily subsidized interest rates.
Which is huge.
It's game-changing. Over a decade and a half, having a subsidized rate drastically reduces the financial friction. It entirely removed the financing risk that has historically plagued this entire sector.
So the financing risk is effectively off the table. They have a $1.75 billion war chest. But here's what you have to wonder, right? How exactly are they deploying that capital to build what essentially looks like a monopoly challenger? Because they aren't the only ones mining rare earths in the U.S. You have major players like MP Materials out there right now.
You do, but the distinction between them and MP Materials is the moat. Traditionally, Western competitors have focused heavily on mining what are called light rare earths.
Okay, elements like neodymium and praseodymium, right?
Exactly. But USA Rare Earth strategy is securing all 4 key magnetic rare earths, including the incredibly scarce heavy ones, specifically dysprosium and terbium.
Wait, why are those heavy ones so critical, though? Why go through the extra effort?
Because of the physics of advanced technology, honestly. You hear a lot about NdFeB magnets, neodymium iron, boron magnets.
Right, super strong ones.
Yeah, these are the ultra-strong permanent magnets required to spin electric vehicle motors or power defense systems. But a pure light rare earth magnet loses its magnetism under extreme heat.
Oh, I see. And EV motors get hot.
Very hot. If you are building a fighter jet turbine or a high-performance EV motor, it gets incredibly hot. You have to lace the magnet with heavy rare earths, like dysprosium, so it doesn't demagnetize and fail at high temperatures.
That makes total sense.
Without the heavy elements, the modern tech transition literally stalls out.
Wow. And to guarantee access to those heavy elements, they are making some pretty massive acquisitions, aren't they?
Oh, absolutely.
Because they already had their Round Top deposit in Texas, but they just pulled off the acquisition of the Serra Verde mine in Brazil. We are talking about a $2.8 billion deal. $300 million in cash and 126.8 million shares.
A massive move.
It is, but why go all the way to Brazil?
Well, the location is actually a massive strategic advantage. Brazil is geopolitically aligned with the West. It operates as a friendly mining jurisdiction, and crucially, it sits entirely outside the Asian sphere of influence.
Which is exactly what they want.
Exactly. Furthermore, Serra Verde isn't some speculative patch of dirt where they still need to do environmental impact studies for the next 10 years. It is a fully permitted, fully operating, heavy rare earth mine.
Okay, that is a huge differentiator. And the filings also mention a 15-year offtake agreement attached to that Brazilian mine.
Right, which is vital.
Yeah, for anyone wondering how that impacts the bottom line, an offtake agreement essentially means a consortium of U.S. buyers has legally committed to purchasing the material before it even comes out of the ground.
It completely de-risks the project for institutional investors because the revenue is essentially guaranteed.
Having guaranteed buyers for the raw material is phenomenal, sure.
Right.
But raw material doesn't solve the supply chain bottleneck, does it?
No, it doesn't, because it has to be processed into metal and then manufactured into those high-temperature magnets.
Right, and that brings us to their facility in Stillwater, Oklahoma. They are targeting initial commercial magnet production there in the second quarter of 2026.
Yep, that's the timeline.
And by the end of the year, they intend to hit a run rate capacity of 600 metric tons per annum, eventually scaling up to 1,200 metric tons.
That's the plan, and it's aggressive.
Let me push back on this execution plan, though, because on paper, it sounds flawless. But let's look at the reality of the logistics here.
Okay, let's hear it.
You are telling me they are going to integrate a $2.8 billion mining operation in Brazil, coordinate that feedstock with a deposit in Texas, and simultaneously commission a highly advanced manufacturing facility in Oklahoma.
It is a lot of moving parts.
It's insane. Any one of those 3 projects could consume a management team for an entire decade. Is this leadership actually capable of pulling this off, or are we looking at an operational nightmare waiting to happen?
Well, you're not the only one asking that. Institutional investors were asking that exact question. The execution risk is massive.
Right.
But remember that $1.75 billion war chest? It allowed them to essentially buy world-class talent to mitigate that risk. Look at the industrial leadership steering this ship right now.
Who did they bring in?
In March 2026, they brought Tom Caulfield onto the board. He's the former CEO of Global Foundries, which is one of the largest semiconductor manufacturers in the world. They also brought in Barbara Humpton, the former CEO of Siemens USA.
Okay, wait. A semiconductor CEO seems like a really odd fit for a company digging rocks out of the ground, no?
And that right there is the critical aha moment for understanding their Oklahoma facility. Building a commercial-scale magnet manufacturing plant operates much more like a high-tech semiconductor fabrication plant than a traditional rock quarry.
Oh, interesting.
Yeah, it is hyper-sterile, ultra-precise, and requires managing these hyper-complex, multi-billion-dollar global supply chains. They aren't bringing in traditional miners for that phase. They are bringing in manufacturing titans.
I see. So the talent actually matches the specific problem they're solving.
Exactly. When you combine that level of leadership with end-to-end control, from the Brazilian dirt all the way to the finished Oklahoma magnet, you create incredibly high switching costs.
Right, because once you're locked in, you're locked in.
Think about a major EV manufacturer. They desperately need transparent, non-Chinese supply chains. Once they integrate USA rare earths magnets into their assembly lines, the engineering validation is so rigorous that they will not switch back to a fragmented, geopolitically risky supplier just to save a few pennies.
That makes total sense. But if they are successfully building this monopoly challenger and sitting on nearly $2 billion in cash, you expect the stock to be absolutely soaring.
But you think so? Yeah.
But it's currently trading at a massive discount. What is the market seeing that we aren't? Let's transition over to how Wall Street is pricing this, because it has been a wild ride.
Very wild.
During the January surge, which was fueled by the news of that PIPE financing and government backing, the stock rocketed to a 52-week high of $43.98.
Which is a completely standard reaction. When major catalysts hit pre-revenue companies that act as proxies for large infrastructure trends, you always see incredible volatility. The initial momentum buyers just flood in.
But it didn't hold that high. It has recently consolidated, trading in a range roughly between $14.64 and $16.78.
Yeah, that's quite a drop.
It is a brutal 64% discount from its peak, yet we just saw a sudden momentum shift. On April 20th, right on the heels of the Cerro Verde M&A news, the stock gapped up aggressively above both its 50-day and 200-day moving averages.
Right. And to demystify the technical terms for a moment moving averages, simply smooth out the daily price noise to show the longer-term trend.
Got it.
So when the stock spends months cooling off below those trend lines, the sellers are usually staking out the speculative traders. You know, the people who bought at the very top in January hoping for a quick profit.
The weak hands, basically.
Exactly. Breaking back above those moving averages aggressively signals that the sellers are exhausted.
So my question to you is this recent April 20th jump just more retail traders having FOMO, chasing M&A headlines? Or does that 64% drawdown mean the stock has finally washed out the weak hands and we are now looking at a solid institutional floor?
Well, if you look at the data tracking market sentiment, what the big institutional players are reading and reacting to, it is aggressively bullish right now. Yeah, the headlines are completely focused on the rare earth trade roaring back to life and the Cerro Verde integration. This isn't speculative chatter on message boards anymore. The smart money is actively anchoring the stock, and the flow data proves it.
We know the smart money is moving in because institutional ownership has surged to 45%.
And look at who makes up that 35%. It is anchored by sovereign wealth funds and major aerospace giants who participated in the January PIPE transaction.
Right. These aren't day traders.
No. These entities do not care about daily chart fluctuations. They take multi-year positions based on structural shifts in global supply chains. And the analysts' price targets imply a massive disconnect between where the stock is trading right now and its actual fair value.
For example, Canaccord Genuity just maintained their buy rating and actually raised their price target from $29 to $32.
Exactly.
And William Blair has a fair value estimate sitting way up at $42, practically right back at those all-time January highs.
Yeah, and when you see professional analysts raising targets while the stock is consolidating and massive institutions buying up nearly half the available shares, it tells you the recent upward movement was driven by fundamental accumulation.
So the speculative froth has been washed away, leaving a much stronger base.
Exactly.
So why is the smart money locking in right now? I mean, they aren't just looking at the technical charts. They see a geopolitical deadline looming on the horizon, don't they?
Oh, they absolutely do.
Let's look at the catalyst calendar over the next few months and, honestly, the existential risks that come with this territory. First up, we have Q1 2026 earnings coming in mid-May.
Now, keep in mind, nobody on Wall Street will care about the top-line revenue number for those earnings. The market fully prices in that they are pre-revenue.
Right. Toll Road isn't built yet.
Exactly. What institutional money will be hyper-focused on is the updated operational timeline. Are they on track for the Phase 1A ramp at the Stillwater facility? How are the integration metrics for Cerro Verde looking?
So it's all about execution.
Yes. Any delay in that second quarter 2026 magnet production timeline is your primary execution risk, and the stock would be heavily punished for it.
Right. And alongside the earnings, we also have the expected April 2026 finalization of that $1.6 billion in Department of Commerce THPS funding.
Which is massive.
But the big catalyst, like the macro countdown that has every institution on edge, is sitting out in November 2026. That is the expiration of the U.S.-China Busan truce regarding mineral export restrictions.
Yeah, and the macroeconomic narrative completely overtakes traditional financial modeling as we approach November 2026.
How so?
Well, if the market fears that China might ban the export of heavy rare earths once the truce expires, global anxiety is going to skyrocket.
Yeah.
And when the market fears a supply shock, they bid up the premium on guaranteed ex-China supply.
So USA Rare Earth's valuation is heavily leveraged to that geopolitical anxiety.
Entirely leveraged to it.
And the rumor mill is already spinning out of control ahead of this deadline. There is unconfirmed speculative chatter floating around about a potential multi-billion-dollar long-term supply agreement with the Department of Defense.
I've heard that, yeah.
The rumor suggests the DoD might act as a buyer of last resort and institute a price floor of around $110 per kilogram for neodymium and praseodymium. On top of that, there are rumors about further M&A action down in South America, specifically in Venezuela, to secure even more raw feedstock before the truce expires.
I mean, those are just rumors right now, but they highlight the very real existential risk that forms the bear case against USA Rare Earth.
Because of China's market share.
Yes. The sobering reality is that China currently controls roughly 90% of global rare earth processing capacity.
It's like a massive game of geopolitical chicken.
Yeah.
Because China holds all the cards right now.
Yeah.
If they see USA Rare Earth successfully building this independent supply chain, what's stopping China from weaponizing their 90% market share?
Well, that's the fear.
They could intentionally flood the global market with cheap, heavy rare earths, completely crash the commodity price, and effectively starve USA Rare Earth at profit margins before they ever reach full commercial scale.
And that is the exact tactic historically used to crush emerging strategic industries. But the rules of the game are being fundamentally rewritten by the U.S. government.
Really? How?
Well, if China decides to play pricing warfare, the structural subsidies in place act as a massive financial shield.
Okay, break that down for me. How do those subsidies actually work in practice?
Let's take the rumored Department of Defense price floor you mentioned. How does a price floor protect them? Imagine China floods the market and drops the global price of rare earths to $50 a kilo just to bankrupt
Yeah,
competitors.
actually a terrible scenario.
The U.S. government simply steps in and pays USA Rare Earth the $60 difference, ensuring the company still receives the baseline $110 per kilo.
Oh, wow. So it completely neutralizes China's pricing weapon.
Exactly. It takes away their leverage.
And you also have things like the Section 45X tax credits.
Correct. Those tax credits specifically reward domestic manufacturing, further padding the margins. It means pure commodity price warfare from a foreign monopoly is far less lethal to USA Rare Earth's domestic thesis today than it would have been 5 or 10 years ago.
That makes sense. The government is essentially signaling that this specific supply chain is simply too important to fail.
Exactly.
So we've covered the balance sheet transformation, the massive operational integration of a Brazilian mine with an Oklahoma high-tech fab, the technical washout of the momentum traders, and this huge geopolitical chess match happening in the background.
We covered a lot, yeah.
Bringing it all together, what is the final investment thesis here? What's the bottom line for someone looking at this stock today?
Well, the bottom line earns an 8 out of 10 bullish score. You cannot view USA Rare Earth as a traditional mining play. It needs to be valued as a sovereign infrastructure asset.
Because they're basically a utility for national security.
Exactly. They are the West's only viable, fully integrated mine-to-magnet supply chain. Backed by a $1.75 billion war chest and the transformative $2.8 billion acquisition of Cerro Verde, they've instantly secured the only ex-China source of all 4 critical magnetic rare earths.
So the execution risk is mitigated by the capital stack and the leadership.
Right. They are now an operational monopoly challenger. With the GPS funding finalization imminent and magnet production commencing shortly, the current 64% discount from its January highs offers a highly asymmetric entry point.
But this requires real patience, doesn't it?
Oh, definitely. The target horizon is a multi-year hold, think 12 to 24 months minimum, to fully capture the value of the Stillwater production ramp and the Round Top milestones. You are investing in a structural re-rating of an entire sector, not a quick swing trade.
Which leaves us with a fascinating and frankly much larger question to mull over. We've spent this time breaking down the mechanics of this one company, but think about the broader implications for a second.
It's massive.
If USA Rare Earth actually succeeds in completely decoupling such a critical high-tech supply chain from foreign dominance, what does that mean for the global balance of power?
It changes everything.
Right. We are talking about the core components that run advanced defense platforms and make the entire electric vehicle transition possible. Will this heavily subsidized, vertically integrated sovereign infrastructure blueprint become the new mandatory standard for Western nations going forward?
It might have to be.
It is a fundamental shift in how we balance free markets against national security. Thank you for joining the conversation today. Keep analyzing the markets, look past the daily noise, and we'll see you next time.